Welcome to the BF Anderson Technical Report for November the 7th. The purpose of these videos is to basically understand trend following because trends are very important and it helps you to understand what is going on. So let's get right into what's going on. The NASDAQ looks very healthy, hit an all-time new high. Moving averages has turned up. This looks like a bull market. It looks like this market will probably rally between here and the end of the year. Now, NASDAQ on a weekly basis, we're seeing very constructive pattern here. This is your 35-week moving average in an uptrend. We never did violate for 2 weeks in a row. Now, remember, this indicator works a certain way, which is if you break, like back here in last year in 2018, we broke below the 35-week, and then we broke below for a second week. That was a sell signal. But right now, we're on a very healthy buy signal on this indicator. Now, I want to take you back in history a little bit because what we're talking about here is a divergence. This is a divergence between growth stocks and value stocks. Now, I was a value manager back in the 80s up until June of 1995 when I switched to a growth strategy. Basically, the value strategy and the growth strategy compete with each other. Value strategy tends to be consumer staples, tends to be things like Kellogg's Corn Flakes, Campbell's Soup, Coca-Cola, those types of stocks. Now, remember, this is a ratio. This is a ratio of the NASDAQ, which is mainly technology and growth stocks, health stocks, retail stocks, things like that. And we are doing a ratio comparing the NASDAQ to the consumer staples, or growth versus value. Now, if we go back in time, I can just simply say that 2013, you saw a major upturn in this ratio. Now, the ratio goes up. That means growth stocks are outperforming. However, in 13, we made our big money in stocks like Tesla and Facebook. In fact, 13 was one of our best years ever. However, we had to plant the seeds for that growth back in 2011, 2012, we started finding Tesla and Facebook and various growth stocks in that period. So we were ready so that when the growth stocks took off, we were there. Now that peaked in around early 14. Then we went through basically a 2-year cycle where growth stocks did not outperform. Now there was a lot of wiggles back and forth, but nothing of any magnitude. Then we got the major sell-off in growth stocks going into the election, and then boom, we started another up cycle that we ended up with a very good year in 2017, and that growth stock cycle did not peak until June of 2018. So we had a nice run here of growth stocks. Now, we had to plant the seeds back here for stocks that we were mainly benefiting from in 17, were things like enterprise software, some semiconductors like NVIDIA, things like that. So what happens is that you'll run out of steam on those stocks. Like, for example, we had Facebook and Tesla back here. Facebook and Tesla really have not outperformed in any major way since that peak. So as Nicholas Darvis said in his book, he said he knew that once these stocks peaked, that it would be a long time before they would resurge again if they ever did. In some cases, they never do. So the growth stock cycle peaked in June of 18. We came down and made a low here right at the end of 18. Now, realize now the market had a really tough time starting in September of 18 till December. In fact, December was the worst December on record. So we made a low here. Then we rallied back up again, and we've pulled back again. Now, if you go back and look at this last bottom in this ratio, it was a double bottom, triple bottom, then we took off. Well, right now we're at a double bottom, triple bottom, and it looks like we're starting to turn. So the rule on this indicator, because there is a rule, the rule is the ratio has to turn up, which it's doing, and the lower moving average, which in this case is the 10-week moving average, it has to turn up as well. Well, it has done that. Now down here at the bottom, I'm showing another ratio. This is the technology stocks, which is the XLK, versus a portfolio of consumer staple stocks, which is the XLP. You're seeing the same pattern, the peak in June, the low in late 18. We rallied, now we're breaking through. So it looks like to me that there's about a 50-50 chance that the underperformance of growth stocks is now over, and we're going to start to see growth stocks start to outperform again. Now, on the advanced decline line, we're still in a very healthy uptrend, really nothing new to report there. On the number of new lows on the New York Stock Exchange, we had 24 yesterday, very controllable number. I think we're good there. On the long-term indicator, now on this indicator, now realize with these trend following indicators, there's several types of signals. A signal would be just when a moving average turns up. That's one signal. Another signal would be when the index crosses back above the moving average. But the real signal on this particular chart is what we call a death cross, a golden cross. We are on a golden cross. The S&P is making new highs. This pattern looks very positive. Now, other good news here. The global Dow, the international stocks are starting to move here. We got a breakout above a trend line where there was a lot of resistance right here, 3,100. Well, we're now roughly 3,150 on the global Dow. We'll talk more about that towards the end of the video. Value line geometric. Now, on growth stock cycles, this is one of the best ways to see a growth stock cycle. With the value line geometric, we got a growth stock cycle that really got started around 1990 and ended at a peak in around 1999, 2000. So you got what we call a super growth stock cycle, which was about a 5-year cycle, and it was led by the dot-coms, things like Cisco Systems, Yahoo, America Online, Amazon. Now, what's happening here is we keep coming up and hitting this resistance, which we believe is now support. So you can see here as of yesterday, the value line geometric has held support and is looking more constructive. Again, we want to see that breakout and start to move up in an uptrend. So far, it has been pretty much moving sideways since 2016. Sentiment, pretty neutral, not a lot to report on sentiment. Now, this is the FFTY, which is a fund of growth stocks. You can see the problem here. Here we are again. This is September, October of 18, the big drop. And basically, growth stocks have not hit a new high where the value stocks are driving the indexes to new highs. Think about it this way. The growth stocks have been outperforming all of 16 and 17 and until June of 18. So that was about a 2.5-year period of outperformance by growth stocks. The value stocks, in the meantime, are underperforming. Well, what happens is they play catch up. So the growth stocks are basically coming down a little bit because they've overperformed, and then the value stocks are coming up because they're starting to outperform. And, with value stocks, we are talking about things like financials, insurance companies, banks, etc. So we're seeing some real positive action there. So when you see the indexes hitting new highs, you have to ask the question, is it being driven by value stocks or growth stocks? In the last, say, 6 months, it has been driven by value stocks. Now, this is an indicator that I want to get you to focus on here for a second. I need you to adjust to it. This is the S&P 500. We're looking at 11-month moving average versus a 13-month moving average. You get golden crosses, golden cross, golden cross, and then we got a golden cross at the very beginning of this year, but we just now got another golden cross. This looks very healthy, but if we go on to the international side of the equation, this was an Investor's Business Daily. U.S. stock indexes drop as global recession fears grow. So there's been a tremendous amount of fear because Europe and China have been slowing. Well, with Europe, Germany's basically gone into recession. But what this particular indicator is telling me is, and by the way, there's a very high correlation to U.S. stocks, here's the S&P 500 down here. But we've gotten a golden cross on the Dow Jones Global Index for the first time really since June of last year. So here we have another international situation. This is France. You can see here France is giving a golden cross for the first time since June of last year. Here we have Germany. Same situation. Germany, as I said, Germany's really had a tough time here, and the indexes have been acting very poorly. But we got a golden cross on Germany. So coincidentally, we're also getting a golden cross on U.S. small cap stocks. So are the small caps going to start leading this market? I think so. I think there's a good possibility of that. Now here is that same indicator that I showed you earlier. I just wanted to show you a larger version of it. This is the ratio of technology stocks versus consumer staples. Again, growth versus value. Well, you can see here we got a peak, a trough, a peak, a trough. We broke that resistance for the first time since October, and it really looks like to me that the growth stocks are starting to reassert themselves. Now here's the top 5. Now again, these are stocks we're watching, but we do own some of these stocks. We own this stock right here. Now this is KLA Corp. What we're seeing right now with these semiconductor manufacturers is that we're going through a metamorphosis in semiconductor manufacturing. In other words, semiconductors are everywhere. They're in your car, they're in your home. With 5G, you're going to have what they call the Internet of Things. I actually read this morning that China is already working on 6G. So these particular technologies require semiconductor chips and different types of semiconductor chips that have to be designed and manufactured. So KLA Corp could be in for a long-term ride here. Also, semiconductor chips are going to be a big factor in things like autonomous automobiles. This is Leggett & Platt, which is home furnishings, very constructive pattern. Again, I think this has a lot to do with home building and low interest rates, and mainly the millennials are starting to buy furniture. Now here is another semiconductor manufacturer. And this is Lam Research. This is the same kind of situation as KLA, very positive pattern. Here is an actual semiconductor that does make semiconductor chips for 5G. Announced earnings, major breakout. This was probably the highest volume ever for the company. Breaks out in a major way and is now going into a nice uptrend. We are looking at this company. So last but not least, we have Seattle Genetics, which is biotechnology. We also own this stock. We got a nice earnings report, a gap up, ascending flag formation, so looks very positive. So all in all, what I'm saying is it looks like Europe is starting to pick up. It looks like the small caps are starting to pick up. This could turn out to be a very constructive period between here and the end of the year. Call me if you have any questions.